No sound, no sound. At least, God, what a terrible start. Sorry, guys. Thank you, thank you, thank you, guys. Sorry for that. Um, okay, we're good. Are we good? Let me know. Can you hear me now? That's what's going on. I've never started the show and being muted. It's all going on now. I apologize. Can you hear me now? I think you guys can hear me. Let me check. All good. Yeah, you can hear me. Okay, what was I saying? Well, welcome to the morning forecast show. Well, I'm glad to see so many of you here. I didn't even know there was that many people in the chat, and I've just seen the chat go crazy. So that's great. Thank you guys for letting me know. Thank you for tuning into the morning forecast show. We are looking at a potential crack in the market that we've been looking at for a few weeks now, which is the private credit market. So we're going to go over to our newsletter again. Be prepared for all scenarios. I'm not bringing this out for just a headline. I'm not bringing this out because I know this is gonna play out into something bigger. I'm bringing it out so we can educate each other, so we can understand the concept, so that if they do propagate into something bigger and this private credit crunch does become bigger than it is currently, that so we are prepared for it and we don't panic if the market sells off, and we know what the situation is, so we can look at the opportunities there. And if it doesn't happen, well, at least you're prepared for it. Again, be prepared for all scenarios. No one knows exactly which way we're going, but if you're prepared for the scenarios, you can take advantage of them, of these scenarios. So let me go to today's. Yeah, we're good. Let me just see everyone in the chat. Thank you guys for letting me know about that technical issue. Um, Morning, everyone. Let me know if you're here. I can see everyone's names popping in. Let me just have a quick look and see who is in the chat. We've got Moon here, Potato Family. Binky Bonk Coin is here. Everyone's saying you're muted, you're muted. Potato Family, David Hensley, William Bond, David Hensley, More Monkey Business. Ricardo Torres is here. Anthony is here. I should do this more often, just be muted so we can get some everyone in the chat going crazy. I love it. I appreciate it, guys. You're muted, Sensei. Thank you, Blood Eclipse. Who else is here? Christopher is here. Richard Torres is here. Chris is here. Yolanda is here. Binky Bonk is still here. Who else do we have? Use Christine here. Let's go through and get up to date with the chat. There we go. Okay. So, on to today's morning forecast newsletter. If I can remind everyone that we're about to release the chart training course, so that will come up at the top of the website. So if you go to sensor.news, you can see all the different products we offer, and the last product in the lineup will be the chart training course. So what you'll see is the XRP weekly, the morning forecast, the portfolio challenge, the week ahead, which is the calendar that everyone can refer back to, the cheat sheets we do, and the net worth tracker. And then shortly in the next 7 days, you will see the chart training course as well. And what we'll be doing is moving our chat integration slowly over to Discord, so we can have a bigger community there, and it's just a better place for the private community. So if you are part of the newsletter, keep an eye out for that. We will be keeping you informed as and when that occurs, probably this week. Okay, so let's go to today's morning forecast, Tuesday, the 17th of March. Today's top stories are: war spirals as inflation bites, diesel costs surge while Iran's leadership falls, leaving the Fed stuck. We'll come on to that. Again, FOMC tomorrow, Japan's interest rates tomorrow. We've got, I think, PPI data tomorrow. I mean, we can go over to our newsletter on the week ahead and see exactly what's going on tomorrow. Yeah, we've got PPI in the morning, so we'll be covering that in the morning forecast show. Then we've got Bank of Canada, which will be doing a rate decision. Then we've got the petroleum status report, DC blockchain summit, and then it's the FOMC decision. Obviously, we'll get the decision, then we'll get the press conference. We've got a big earnings, Micron Technology, and then later that night in the US or early morning here in the UK, we'll get the Japanese rate decision and then the Japanese press conference as well. And then the Bank of England will report Thursday morning. The ECB will be doing their rate decision early morning. and then we'll get some jobs data the day after. So a lot going on in the next 48 hours, plus the private credit crunch. So we wanted to get this out before we cover the rest of those events. If you have just tuned in, if I can ask everyone to make sure you've hit the like button, subscribe if you haven't done so already, that will be great. Binky Bonk. Sounds so funny when you and Martyn say it. Yeah, you changed your name to Binky Bonk Coin. That's a good username you have there. We should have grabbed it before you did. I don't know. I do love you, Sensei. You're the salt of the earth, brother. Thank you, RoPro. I really appreciate it. Okay, then we had Nvidia yesterday. Remember, it was on the weekly calendar that we're going to have that Nvidia report, and we did. And they debut its $1 trillion super chip. Essentially, is what they're the way that event went, announcing potentially trillions dollars of sales on their new chip. The new Vera Rubin platform targets massive orders by boosting performance. We've got a judge blocking RF Kennedy's vaccine cuts. We've got Meta cutting staff for AI, thousands losing their jobs at Meta. And we've got Trump slamming the UK's war stance, plus our deep dive today, which is the private credit faces liquidity crisis. Major funds freeze withdrawals as banks mark down collateral, sparking fear. Do we have another 2008 on our hands? Well, we'll get onto that shortly. Just a quick bit about the FOMC tomorrow. The one big thing, so the Fed's stagflation trap. The Federal Reserve faces a tightening stagflationary bind as escalating energy costs from the Iran conflict clash with deteriorating labor market. That's going to be the talk of the town. The questions are all going to be, I can already see it. I can already see Jerome Powell's press conference tomorrow. Remember, we will be covering the FOMC tomorrow. I can already see the press conference all talking about stagflation, all talking about energy costs, all talking about inflation, rate hikes they're going to be discussing. I can already see what the press conference is going to sound like. We will be sending out a cheat sheet tomorrow, so keep an eye out for that. If you don't have the newsletter yet, I am actually going to give you the code now, because every day we're giving away 3 newsletters at 50% off for the next I don't think Monday next week. I think there's a date on the discount code, but there's only 3 a day. And if you want to get all those perks we just spoke about and get the cheat sheet, then let me pin that. It's the first 3 people every day. So if you missed your opportunity yesterday, you can do it today. Ricardo just said, many investors have been looking at credit defaults in the private sector. I didn't notice till the end of February. Yeah, we covered Blue Owl, I think it was in a newsletter, and I think we did a live show on it probably 4 months ago. We started looking at it, then we had a follow-up a couple months ago, but now obviously we're starting to see more and more, and that's one of the reasons the S&P 500 is falling off. So this is probably the biggest report we've done on it since it happened. I'll come on to it in a second, Ricardo. I know you wanted this to come out. It is the deep dive today, so go and check it out. We will come on to it in a second as well. Yeah, I can already see tomorrow with the FOMC report, everyone's going to be asking about the war. Jerome Powell, what are you going to do? The inflation's going up. Are you going to raise interest rates? That's going to be the talk of the town. We're now seeing at the pump in the US that diesel prices are exceeding $5 a gallon, and are fueling inflation while domestic growth and consumer sentiment reaches historic lows. If you guys are in the US, have you seen a $5 diesel in the US? Yes or no? Let me know in the chat. If you are from the US, tell me yes or no. Has it hit $5 yet where you are? And the volatility prevents the central bank from cutting interest rates to support the economy without risking persistent price hikes. Investors are consequently repricing assets for an environment with fewer anticipated rate reductions through 2026. Historical data suggests these energy spikes frequently precede global recessions. When we see energy spikes, when we see oil spike, when we see that late cycle behavior, that is normally, we see that every single time before a recession. It doesn't mean every single time we see it, we get a recession, but every time we've got a recession, we've had these end of cycle behaviors. And again, we're getting it now. So does that mean we're going to a recession? Well, it doesn't mean we are going to a recession, but it is a prerequisite for a recession, essentially. The core tensions lie in the Fed's inability to address falling growth. So we've got growth falling. Remember, we saw I think it was 2 weeks ago, 3 weeks ago, we saw GDP. It was supposed to be 3.4%. We got 1.4%. That was the first revision. Then we got the second revision just a few days ago. And everyone was expecting, okay, it can't be any lower than 1.4%. It halved to 0.7%. So essentially, we're getting growth that is much lower than expected. And we've got inflation going up. So we are in this part of the stagflation trap that the Fed will have to try and navigate. There's no great options for the Fed right now, and it's all about the tone of Jerome Powell and what they say in their dot plots and what they say in their economic summary of economic projections, which will be coming out tomorrow alongside the rate decision. So a lot to analyze there tomorrow, but we're going to break it down in that cheat sheet for you. Um, Let me have a look. Yes, you guys have seen $5 at the tank. Let me have a quick look at the live chat. What are you guys saying? Many investors between 5 and 10,000 per bank is what you can expect on XRP. Between 5 and 10,000 per dollars per bank. What do you mean by that, Wolf Speech? I have no idea what you mean by that. Yesin says, hello, everyone. Ricardo says, yes, he have seen $5. Sergio says $4 to $5 depending on the store. Well, that's a big range. Here is only like a couple cents different depending on where you go. Blood Eclipse says, it hit $5 in the eastern part of Washington, said Blood Eclipse. Yeston is in the chat. Lovely to have Yeston here, one of our members for over a year and a moderator of the channel. Game Over says Yeston. Zach Melu says over $5. MP Gareth Garner says yes, 509 at Flying J Truck Shop. Zach Mello says 515, 520 in Florida. So okay, everyone is feeling the effects, and this is going to be a point mentioned against Trump, and also a major point discussed probably behind closed doors and in the press conference tomorrow, the FOMC. $6.30 in California, says Juan Pino. $6.30 in California. That seems very high, but I guess California is always going to be more expensive. The number that matters is 265 billion. Why? Well, that's the amount in market capitalization that has evaporated from alternative managers as private credit redemptions freeze. Essentially, you can't get your money out if you're in some of these funds. And it can get much worse. Today's deep dive examines how this $2 trillion sector faces a structural reckoning driven by back leverage and rising software sector defaults. Okay, so what I'm going to do now is I'm going to go past these stories. Again, there's some very important stories, and most people, even if you're on the free newsletter, you get to access some of these top stories, the 5 things. Go and read them, because we've got a big story about diesel, Iran, and the Fed. We've actually had to extend it to. I normally try and keep it to 2 paragraphs, but because it's such a big story, I actually had to make it 3 paragraphs. We've got Nvidia's. If you don't know what happened yesterday with Nvidia, there's a story there for you. We've got the RF Kennedy vaccine cuts that was overruled. We've got Meta with AI. Remember how much money they've invested in AI, and now we're seeing the effects of it. That's a very important story. And then we've got Trump calls UK approach terrible in sharpest US UK rift in decades. What we're going to do is make a video on the deep dive. Sensei, what's your baby boy's name? It's Mini Sensei. Mini Sensei, we can call him, or little whatever. We need to get the Lucasades to come up with a name for little Mini Sensei. Okay, let me make this into a video, and then we will go on to the top story, which is obviously the private credit crunch. Okay, got something in my eye. I apologize. I think it's that. Oh god, I've got something in my eye. I apologize. Okay, let me turn this into a video. Do, 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 do. Okay, so yeah, we're going to come on to private credit crunch, what's going on, why it matters, and what will happen next. But what I'm going to do first is come to this screen over here and turn this into a video. So if you are watching live, I'm going to be making this into a video, so don't get confused. You're obviously the first people that get to see it before it premieres later today. So let me just get this over there. And let's turn this into a video. So if you have just tuned in, guys, please hit the like button. We're about to talk about private credit. 5 of the biggest funds in private credit have frozen investor withdrawals in the last 6 weeks. Banks are pulling back, and Morgan Stanley just warned default rates could hit 8%. So today we're breaking down what's actually happening, how bad it can get, and what it means for the broader markets. So let's go to our very own deep dive within our newsletter and break it all down. If you do want the newsletter, we are giving away 3 people every day for a week to celebrate the launch of our training course, 50% off. Remember, the newsletter isn't just the news. We've got many products on there as you get it. There's also a free plan, so go and check it out. The $2 trillion private credit market is facing something it has never experienced at this scale: a genuine crisis of confidence. Over the past 6 weeks, 5 major fund managers, Blue Owl, Blackstone, BlackRock, Morgan Stanley, and Cliffwater, have all either capped or scrambled to meet investor withdrawal requests from their flagship credit funds. It's giving us deja vu of 2008 a little bit, especially with the market already forming cracks in other ways. Lots of other cracks in the markets, but today we're focusing on private credit. JPMorgan has started marking down the value of its loans it holds as collateral from these funds. Deutsche Bank has disclosed $30 billion in exposure to the sector. Morgan Stanley analysts now forecast default rates could hit 8%, and regulators are paying attention. The Financial Stability Oversight Council has stood up a new working group on market resilience and non-bank risks that explicitly include private credit. This is the first time the post-2008 private credit machine has been tested through a genuine stress cycle, and it's now multi-trillion-dollar form. So let's break this down. What's actually happening? How bad could it get? What keeps it contained? And what is most likely to happen from here? Have a look at Blue Owl's stock price. Blue Owl Capital has lost roughly 67% since its peak in January last year, making it the most visible casualty of the private credit stress. We've got Blue Owl Capital, one of the largest companies out there in this industry, and it's lost literally 70% of its value in about a year. We can see how bad this is. So what is going on? Let's break it down first, and then I'll tell you why this can make the S&P 500 drop another 25% and possibly the crypto markets 50-60%, and this might be the final capitulation event that sort of throws us into that recession and the opportunity on the other side. Again, this is not guaranteed to be that bad, and we're going to go through all the different options, but you need to be prepared for scenarios like this. So let me tell you exactly what's going on. Private credit, in simple terms, is loans made by non-bank lenders to companies. After the 2008 financial crisis, tighter rules pushed the banks away from mid-market and high-risk lending. Investment firms like Apollo, Blackstone, and Ares stepped in to fill that gap, building what is now a $2 trillion to a $3.5 trillion global market, depending on how broadly you measure it. Let me, someone's being, can the moderator take care of the person in the live chat, please? Because that's a strange comment and we don't like it. The pitch to investors was compelling. I apologize for that. We're making this during a live show, and all sorts goes on during a live show. So the pitch to investors was compelling. Yields of 8 to 12% a year, low volatility compared to public markets, and periodic redemption windows, usually quarterly, so your money was not locked up forever. Over the past 5 years, the industry aggressively courted everyday investors through products called non-traded business development companies, or BDCs. These grew from about 45 billion in 2021 to about 230 billion in late 2025. But here's the problem. Let me just make sure someone's taking care of that. No, I will do it. Let's do it. There we go. The cracks start. So here's the problem. The loans inside the. I think I'm gonna have to start this video again because this person's really put me off. What sort of comment is that? Let me just time this person out. Um, that's a weird thing to say. Okay, I'm gonna have to time that person out. Um, Morning all. Let's hope more green on the screen. Sensei, I'm gonna have to start this video again. I apologize, guys. That's really put me off. So let me do that again. Uh, Let me go back to the beginning of this. Five of the biggest funds in private credit have frozen investor withdrawals in the last 6 weeks. Banks are pulling back, and Morgan Stanley just warned default rates could hit 8%. So today we're breaking down what's actually happening, how bad it can get, and what it means for the broader markets. So let's get straight into it because this is a very important update in the markets. We have covered private credit before on this channel, but now we are starting to see bigger cracks forms. This could be the element that forms the recession that we have been alluding to. Again, I don't think a recession is the highest probability chance, but that chance of a recession is certainly increasing, especially with oil prices. And if we're starting to see a broader sell-off and people starting to get scared, they will be trying to withdraw their money. And if they realize they can't withdraw their money, massive panic will occur and more funds will stop allowing withdrawals. It will give us a sense of 2008 all over again. So let's get straight into it. Let me tell you how much the market can fall and what needs to occur for that to happen. We'll go straight into our very own newsletter. First link in the description. We're giving away 3 people every day get 50% off the full newsletter, which has the portfolio challenge, the deep dives, the daily newsletter, the app, the Discord integration, and many more. Or there is a free plan as well, which is certainly still worth getting. So go check that out. So the private credit crunch, what is going on? Well, the $2 trillion private credit market is facing something it's never experienced at this scale, a genuine crisis of confidence. We've seen 5 major fund managers, Blue Owl, Blackstone, BlackRock, Morgan Stanley, and Cliffwater, have all either frozen, capped, or scrambled to meet investor withdrawal requests from their flagship credit funds. People want their money, and they're not getting it. JPMorgan has started marking down the value of its loans it holds as collateral from these funds. Deutsche Bank has disclosed 30 billion in exposure. Default rates could hit as high as 8%, which is really concerning. And regulators are paying attention. We're seeing different councils step up and look to regulate the private credit market even more. But this is the first time since the post-2008 credit crunch that has been tested for a genuine stress cycle, and it's now multi-trillion-dollar form. It's much bigger than it used to be in 2008. So let's break this down. What is actually happening? How bad can it get? And what keeps it contained? And what's most likely to happen from here? We can see Blue Owl Capital, something that we mentioned earlier in the year. Now it's down 70% from its highs just about a year ago. So let me just tell you what private credit is first and what is going on in simple terms. So private credit is loans made by non-bank lenders to companies. So these are not banks' normal loan process. These are non-bank lenders giving money to companies. And after 2008 financial crisis, tighter rules pushed from the big banks away from mid-market and high-risk lending. Investment firms like Apollo, Blackstone, and Eris stepped in to fill that gap, building what is now a 2 trillion to 3.5 trillion global market, depending on how broadly you measure it. The pitch to investors was compelling. You get the people that invest in these funds, and there's people, I've looked at these funds, people in this channel have looked at these funds, I've brought up my concerns, but it looks great on surface value. You get 3 to 12% yields a year, low volatility, and periodic redemption windows, usually quarterly, so your money was not locked up forever. So they're saying, here's our product. Buy it. It's less volatile. It's going to move, but you get a guaranteed 8 to 12%. And every so often, we will let you withdraw your money every quarter. So your money is not locked up forever. Over the past 5 years, the industry aggressively courted everyday investors through products called non-traded business development companies, or BCDs. These companies grew from 45 billion in 2021 to roughly 230 billion in late 2025. But here is the problems. The loans inside these are illiquid. And what do we mean by liquid? You can't just sell them and get your money tomorrow. They cannot be sold quickly at fair value. We've seen it's somewhat similar to slippage on crypto. If you've ever gone into a crypto market and tried to buy an altcoin on a decentralized exchange, and there's not that much liquidity, and we saw a mass event last week with Aave. Someone tried to buy, I think it was 50 million or 50. Yeah, I think it was $50 million worth of Aave, but they did it on, and Aave is a cryptocurrency. They did it on a decentralized exchange, and the liquidity wasn't there. So they spent 50 million, but they only got £5,000 worth of Aave. So if the liquidity is not there, you're not getting your money back at fair value. You'll get something back, but not at fair value. So the funds themselves offer periodic liquidity. That's how they function. They say you can't take your money out every time, but we will give you periods where you can get your money out, and we'll provide liquidity. And that gives the impression that their money would come and go relatively freely. When confidence holds, the structure works fine. So if everyone's happy, the markets are looking good, and no one's panicking, it works brilliantly. Great product. But when confidence cracks, the mismatch between what the fund promised and what it can deliver becomes an entirely different story. And there is where we are today. The crack started in late 2025. First, brand groups and Tricolor Holdings both went bankrupt amid fraud allegations and a double pledge collateral. So that's what happened first. Late 2025, two went bankrupt because of fraud. Then JPMorgan CEO Jamie Dimon warned about cockroaches in the private credit. Jamie Dimon making his warning. In February, the UK bridging lender Market Financial Solutions collapsed into insolvency, revealing a shortfall of around 930, and that exposed Barclays to an estimated 600 million in losses. Blue Owl became the flashpoint. You've probably heard of Blue Owl, because that's where all eyes turn to next. The firm permanently shut down redemptions from its $1.6 billion OBDC2 fund after withdrawal requests pushed well beyond the 5% quarterly cap. So there's a cap on how much how much the fund can withdraw, and this is a $1.6 billion fund, and everyone wanted to, or lots of people want to withdraw, or even 6, 7, 8, 10% of people want to withdraw, but they could not do it, and that caused panic, causing more people wanting to withdraw and causing bigger issues, as we've seen, a run on the banks essentially, but it's a run on private credit firms and funds. So its stock has lost roughly 70% of its value over the last 13 months, and its shareholders have filed a lawsuit. From there, the dominoes started falling fast, and this is the issue of this. Once it ignites, it's very hard to keep it in check without major intervention from possibly the Fed. So here is where things stand across the 5 big funds caught up in the redemption wave. So we've got OBDC2, which is Blue Owl, 1.6 billion, and well above 5% have requested their money out. They have they're winding down, returning up to 30% of net asset value. So 70% wiped off the value there. We've got Blackstone, which is 7.9% of people have requested their money back. Their size is 82 billion. That's 80 times larger, 70 times larger than the Blue Owls one. And they've met 7.9%. So then Blackstone is keeping up for now. So they've raised the cap, 400 million firm capital, $400 million capital injected. We've got BlackRock with 26 billion. 9.3% of people are asking for their money back. They've only managed to do 5%. So the first time breaching its cap since inception. This is the first time since this fund started for BlackRock that people are wanting their money back more than they can give. We've got Morgan Stanley the same, 8 billion. 11% of people want their money back, and they can only do 5%. So they've only managed to do about 45% of their requests. We've got Cliffwater, $33 billion is the size of that fund. 14% of people want their money back, and only half of them have been resolved. So you can see this could spiral, and even someone like BlackRock, they're not being able to pay all their money back, and they're the biggest one. So that's 5 major funds in 6 weeks. Investors want out, and the funds cannot move fast enough to pay them. The panic is spreading internationally too. Private bankers across Hong Kong and Singapore are fielding urgent calls from high net worth clients warning to redeem. The Hong Kong Monetary Authority has contacted private banks to assess their exposure. Asset managers including Blue Owl, BlackRock, KKR have been hosting in-person events in Asia trying to calm nerves. You can already see, I mean, it's not, if they're panicking and doing in-person events, does that really calming nerves, or is it making it sound like they're panicking a little bit? For some investors in the region, this feels like deja vu after Credit Suisse AT1 wipeout in 2023 and the Lehman Brothers mini bonds in 2008. The sell-off is publicly traded. The sell-off in publicly traded alternative asset managers tells you the market's mood. From their peaks, Apollo's fallen 41%, Blackstone 46%, KKR and RS 48%, and Blue Owl about 70%. Over 265 billion in combined market capitalization has been wiped out. How could this get worse, you may ask? Well, the redemption wave is as bad as it looks. The redemption wave, as bad as it looks, is only one side of the problem. So you think that's bad? Well, that's limited. That's one side of the problem. The other side is where the real risk, the broader financial system sits. And to understand it, you need to understand how leverage works in this market. So, when banks pulled back from direct lending in 2008, they did not leave the private credit ecosystem entirely. So remember, the banks left this market, but they didn't really leave this market. They came back through the side door. They always find a way, don't they? They never learn their mistakes. They came back through a side door, lending roughly 300 billion. So they're lending money to these private credit funds themselves. So they've lent nearly 300 billion to private credit funds themselves, using funds loans portfolios as collateral. This is called back leverage. And not many people know about it. And it's quietly become the plumbing connecting private credit to the traditional banking system. So if you thought the traditional banking system is not exposed to this because of the rules that were put in place in 2008, you're wrong. They found the side door, like the banks always do, and now they're using back leverage. Think of it like a chain. The company borrows from the private credit fund. The private credit fund borrows from the bank against those loans. The bank itself is leveraged, and sitting above it all are these pension funds, insurance companies, and retirement accounts whose money is in the system. Every layer is borrowed against the layer below it. So every layer is borrowed against the layer below it. That's why a problem in one corner can ripple outward very fast. You do not need the whole system to go bad. Not everything has to break. The banks don't have to break. One thing has to break. You just need enough of it to start a chain reaction, and the dominoes will fall. In 2008, less than 5% of mortgage loans actually defaulted. That was enough to collapse the whole global financial system. In 2008, less than 5% of all mortgage loans actually defaulted. Only 5%, less than 5%. But that broke the whole financial market. JPMorgan has become the first major bank to start pulling this chain apart. It marked down the value of its collateral it holds from private credit firms, specifically loans to software companies, and began restricting how much of these funds can borrow. The reason is straightforward. Software as a service business was a favorite for private lenders in 2020 onwards because of their recurring revenue and high margins. And remember, we've talked about the software industry. Software was very hot 5 years ago, but AI, as I've said, I keep telling you, AI is going to change the world. It's the biggest invention since probably like electricity or fire. I don't know. It is massive. So don't be, and it's wiped off a lot of money from certain markets. And one that was hit hard, that wasn't expected to hit hard, was software. Because in 2020 and 2021, everyone loved software because it was such a booming market. You create a piece of software and you can just keep and selling it with very high margins. And that's where private credit lenders were lending their money out to software companies because they're like, wow, these software companies are great, and we love this market, and we're going to keep lending money out. And then AI changed the game, and they didn't even see it coming. 5 years later, or 3 years later, here we are today, where AI can build software much faster, much quicker, much less money, and has to go into it than these companies that were borrowing money 4 years ago. So these companies have lost value. We've talked about the software industry, whether it's Microsoft, which we've seen the correction, or Salesforce, or smaller companies that are raising money through private credit. And what's happened here is the reason is straightforward. Software as a business, as a service businesses were a favorite for private credit lenders from 2020 onwards because of their recurring revenue and high margins. But advances in AI have raised serious questions about whether many of those businesses will hold up. If AI tools can replicate them, if AI tools can replicate what a mid-tier software company does, the revenue that underpins those loans starts to erode. Morgan Stanley quantified the problem this week. Their analyst forecast default rates in direct lending will climb to 8%, driven by AI disruption of software companies. Software is the single largest sector in the BDC portfolios at roughly 26% exposure. And the maturity wall is front loaded. 11% of software companies come due in 2027, another 20% in 2028. This means a huge wave of refinancing is approaching at exactly the moment when lenders are pulling back. Partner Group's chair Stephen Mister warned separately that default rates across private credit could double from their decade-long average of 2.6%. His reasoning was simple. Credit lenders bear the full downside when things go wrong, but only ever capture interest when things go right. In a world where AI is creating a wider gap between winners and losers, the aim symmetry gets worse. As PIMCO's president Christian Strack put it, this is not just a crisis of confidence, it is a reckoning driven by years of poor lending standards and overly optimistic assumptions. If JP Morgan marks down If JP Morgan's markdowns become an industry-wide pattern, it reduces the borrowing capacity of private credit funds across the board. This creates a margin call dynamic at exactly the wrong moment. The mechanics is straightforward. A private credit problem becomes a banking problem through back leverage, and a banking problem becomes everyone's problem. So what does this mean for the broader stock market? If you're looking at the S&P 500, it's peaked around 7,000 as expected this year, and it's currently trading around 6,700. If this stays contained to the private credit lenders and doesn't come to the banks, the damage probably stays in the alt managers and the bank stocks. The index might pull back a bit further, but nothing dramatic. If it does not stay contained, if back leverage tightens across Wall Street and credit conditions start to squeeze the real economy, this is when things get more serious. The historical playbook for credit-driven slowdowns point to about 15 to 25% correction from the peak. A 15% drop from 7,000 puts it at around 6,000 for the S&P 500. A 25% drop puts it closer to 5,250. For context, remember 2022, not long ago, that tightening cycle produced roughly about a 25% drawdown. We're not there yet, but the path from here to there runs directly through the 5 things we cover in the what to watch section below. So are we going to get there? Well, I'm going to come on to what to watch now. The Van Eck BDC Income ETF, this is something a lot of people are invested in. The broadest public proxy for the BDC sector is down roughly 30% over the last 13 months. And this is supposed to be something that pays you a good dividend. It's still paying the dividend, but it's also losing more money than the dividend is paying. So now BDCs pay high dividends, typically 10 to 12% range annually. So the total return, including those payouts, is closer to around 20%. But that is still a brutal number for a product that was sold the promise of steady bond-like income. You've sold a product, get your income, 12%, pretty guaranteed. And look at this, it's down 30% just in the last 30 months when it's supposed to be paying you, let's say 12%. So you're still down about 20% on a bond, which is supposed to be safe. So what could keep this contained? Now, before anyone starts panicking, remember there's two sides to a coin. If this was guaranteed, the market would already be down 25%. And the reason it's not down 25% yet is because it can be contained. So here's some important reasons why this might not spiral and the domino effect might not take place. Goldman Sachs estimates that the at-risk portion of the market, the retail-facing evergreen funds at the center of this redemption wave, at roughly 220 billion. That's saying what that exposure is to the redemption wave. That's about 20% of the direct lending universe. The other 80% is held in long duration drawdown funds, separately managed accounts, and publicly traded BDCs with no on demand withdrawal mechanisms. Those structures do not face sort of a run on the bank risk. Howard Marks, co-founder of Oaktree Capital and one of the most respected voices in the credit market, stated there's no systematic problem. He warned that the sector's rapid expansion could expose weak lenders, but the core of the market remains sound. Even PIMCO's Strachey, um, despite his sharp criticism of underwriting standards, said a broader credit crunch is unlikely as long as the US economy holds up and the Fed is inclined to cut rates or stay on hold. Now, that's the important part. This is when we come on to something else, which is the other concerns we're talking about. This guy is saying everything's fine as long as the US economy holds up and the Fed cuts rates or holds them and doesn't raise them. Well, unfortunately, right now, what we've got going on is the oil sending a spike into the markets. That's sending inflation up, whether it's inflation through petrol costs or inflation through fertilizers or anything that oil transport or all these companies. If inflation goes up, the Fed might need to raise rates. So if they raise rates, the US economy isn't going to hold up because right now we've got another growth fear in the economy as well. So that's a nuance there as well. Morgan Stanley's own analyst said the risks are significant but not systematic. Sorry, systematic. Systematic. So it's not going to be across the whole board. It's going to be contained and pose limited danger of spillover. The worst historical parallel is Blackstone's non-traded real estate fund, BREIT, which hit its redemption cap in late 2022 after investors tried to pull more than $4 billion. It survived, it recovered, it remained a functional vehicle, but it took months of stress and negative headlines to get there. Remember, real estate funds are notorious for not being able to be liquid because at the end of the day, the money's in the building. So they need to sell the houses or whatever they're invested in to actually pay investors out, or they need to borrow money. But this one made it out. If the Fed doesn't cut rates, roughly 27% of private credit borrowers who cannot currently cover their interest payments from their operations get immediate relief. That's if the Fed cuts rates, then they will be able to pay for it. But default rates stay manageable. The weakest lenders wind down, the strongest absorb the pressure, and the industry consolidates if they cut rates. So here's what we watch from here. Five things matter most over the next few months. Because as I've said before, if we knew this was going to be the biggest concern and it's going to spill over, then the market would be down and we'll price it. If we knew we're going to be completely fine, then the market would price that and these companies wouldn't be down 80%. So we're going to be one way or another. We're either going to recover and these companies are going to go back up and these bonds are going to be sound, or it's not going to be fine and we're going to crash. And it's going to go one way or another. So be prepared for all scenarios. Again, my £5,000 portfolio challenge, I am sitting a lot in cash, getting ready for opportunities, but I'm also investing in the market because I don't want to miss out. So it's always great to be invested, but be prepared because you don't want to be out the market because you miss most rallies. And the research suggests the longer you're in the market, the more likely you are to win. But it also suggests if you can buy the dip and you can buy these crashes that may occur, you're going to make a lot of money in a short amount of time as well. And it can build a nice base for your portfolio. So in my opinion, I'm prepared for all scenarios. If you want to see what I'm doing with my money, there's a £5,000 portfolio challenge. There is the daily newsletter. There's the daily deep dive. There's the charts of the days. There's a chart analysis course. There is the net worth tracker. The one-on-one DM access, the weekly crypto report, you can be part of the private community as well. All of these perks you can get for the first 3 people every day for this week, get it 50% off. And there's also a free plan. There is the first link in the description. So Here's the 5 things you need to watch. First, Q1 2026 BDC earnings in April and May. The key numbers are non-actual rates. That's what we're looking out for. And the percentage of income coming from payment in kind, or PIK, where interest is paid by issuing more debt instead of cash. Non-accruals have been, so imagine they don't have the money to pay you, so they're just going to take more debt to pay the interest. That's not good. Non-accruals have been running around 1.5 to 2%, but the shadow default rate may have already been as high as 5 to 6%. If official non-accruals jump materially, the conversation shifts from liquidity problem to credit quality problem. Number 2, whether other banks follow JPMorgan in pulling back leverage. This is the single biggest variable. If markdowns and lending restrictions spread across Wall Street, it creates a feedback loop where funds lose borrowing capacity just as they need liquidity boost. So if people follow in JPMorgan's footsteps, then that could spiral out of control. Number 3, the interest rate path. If the Fed cannot cut, borrowers who have already struggled who are already struggling get worse. If the Fed does cut, the pressure valve opens. So if you think rate cuts are just limited to to just companies within um, the smaller companies, that this will ripple across the whole market. If the Fed cannot cut, there's companies, there's borrowers who are already struggling right now, and they can only pay it if the Fed do cut. If they can't cut, then the pressure valve opens. Number 4, and right now it's not looking good for cuts. Number 4, fourth, whether more corporate blowout surface. First Brands, Tricolor, Market Financial Solutions were each called one-offs at the time. Together, they look like a pattern. A default in a software company with significant private credit exposure could trigger another wave of panic. So if we're getting defaults, especially keep an eye out for the software sector, then that can go from a one-off to a bigger problem. Fifth, the software maturity wall. Morgan Stanley's data shows 31% of software company loans coming due by 2028, meaning the refinancing pressure is front loaded. Companies that cannot refinance will either restructure or default, and we're coming up to when those software loans are due. The market is already pricing in serious pain across the sector. Blackstone, the largest alternative asset manager in the world and the bellwether for the entire industry, is nearly down 38% year to date. Not on the 1 year, year to date. That's the worst start in a year to the year in over a decade. Look at their chart, down 38% year to date. This is the largest alternative asset manager. So what is actually most likely to occur? This is what's most likely to occur. This is probably not 2000. This is most likely. And if it was not most likely, then the market will be pricing in 2008. So what's most likely to happen? This is probably not 2008. The at-risk sentiment is roughly 20% of the direct lending market. The other 80% doesn't face a run risk. The largest managers have shown they can absorb significant withdrawals without forced selling. The most likely path from here follows the bright playbook. Months of bad headlines, some weaker players winding down, and a few ugly earnings reports, and eventually stabilization once the worst of the redemption cycle passes and the Q1 data gives the market something more concrete to price. The industry consolidates around the strongest managers, the spread widens, underwriting standards tighten, retail enthusiasm for semi-liquid credit products cools permanently. The scenario that changes everything is if defaults jump sharply. If people default on their loans and that jumps sharply, that's when more banks restrict lending and the Fed stays on hold. Morgan Stanley, these are the things that will cause the market to come down. So the scenarios that change everything is if defaults jump sharply, if more banks restrict lending, or if the Fed stays on hold. And we've got a big risk of the Fed staying on hold. We've got banks already showing signs of restricting lending and also defaults jumping sharply. I'll give you my thoughts in a second. So Morgan Stanley's 8% forecast for software-driven defaults combined with front-loaded maturity wall makes the next 12 to 18 months the critical window. The pattern with every liquidity crisis is the same. Money goes in through the front door easily, but when everyone tries to leave through the back door at the same time, the door is never big enough. Right now, the door is tight. It has not broken. So that's our analysis. We're going to keep up to date with this. Please do make sure you grab the newsletter. It's the first link in the description. Please do stay with us on the channel. We will be covering the FOMC tomorrow. We'll be covering all of these events. And my thoughts are the market is more priced in that this is going to be fine than it is that this is going to be a problem. And right now, my thoughts would be this is a risk, about 30 to 40% chance that it unwinds, and the risk is a broader sell off. So, again, a few cracks in the market that we're following: the carry trade unwind, the private credit market, the AI cracks, the software cracks, the Fed not cutting rates like we expected, which we predicted last year. They're probably going to hold or have a one rate cut. The Iran war, how long is that going to happen? Is there going to be boots on the ground? Oil spiking above 100 and staying there. There is a lot of risks in the market that I believe the market isn't pricing in appropriately. And that's why I'm on the side of the trade that I'm just being a bit more cautious, having a bit more money on the side to take advantage if it does occur. Again, it's less likely that something big does happen to crash the markets, but that risk is increasing. And that's why I am structuring my portfolio way to take advantage of what happens. But again, I share that in the portfolio challenge. I share that in the newsletter. I'll keep you guys up to date. Let me know your thoughts in the comment section down below. I'll put the link to newsletter 50% off link just over here. And there'll be 2 videos up here for you to watch. But until next time, as always, take care of yourselves and each other. Okay, let's go over to Martyn. I think he will be live shortly. Let me go over to your comments as well. Let me see. Do we have a link from Martyn? I'm going to go through your comments. We've got a couple minutes, and then I'll be ending the show. Let me go through your comments. So, and I'll also end the poll. Has everyone voted in the poll? Vote in the poll, and then I'll end it in a second. I'm about to send a search party out. What, you're about to send a search party out? For what, David Hensley? Nobody says that this is the story to get us transition over the way out, the solution. Yolanda says, David, her mum is visiting her for a week. That's probably why she's not here. I'm sure she's still thinking about the show right now. Is that Liz? Is Liz's mum visiting her? That's right, Yolanda, Liz is. How you guys make me laugh. I hear someone is missing, lol. Just a quick hello from the supermarket. Liz, lovely to have you here. Is your mum visiting you this week? Is that why you keep popping in and out? Good morning from Fort Lauderdale, says Guy Kemp. Let me just make sure I've got. Oh, okay. Sorry, I've just seen. Okay. I'll send to extra. Martyn's having some issues. So what we'll do is Martyn will be live later in about half an hour. So what I'm going to do is send you guys to extra channel, and then Martyn will be live in about half an hour. So let me go there. Hope everyone's doing good today, says Human Being Liz. Much better, says Zach Zay. Human Being Liz says, you know me so good. Thanks, Sensei. I'm going to translate later the email. No worries. Yeah, it's great that you've got the email. Yeah, I know. It's actually great because people can go back, and the premium members can go back and read the deep dive. They can translate it to their own language like Liz does, or keep it as reference. So I'm very happy that these go out not just as videos but also as newsletters. And most of the time we don't cover the deep dive on the story, and also half the time we can't even cover the top stories. So the newsletter has a lot of information that everyone needs to read, especially the 5 things today. Major psychological dump for XRP incoming sensei. Hold or sell through this one because it will be the last. Look, I'm in. I'm holding. If we go up to levels such as 160, 180, $2, then I've got a trading part of my portfolio. I'll sell it, and I've got money on the side. So if we crash to $1, I'll buy. If we crash to 80 cents, I'll buy. If we crash to 50 cents, I'm prepared. I'll buy. Right now, it does seem like we're on the bullish wave, though, to reach some of these targets, as long as the broader geopolitical issues don't cause a problem over the next couple months. Will Martyn be live later? Hope I make it for a little. Yeah, Martyn will be live. Human Being Liz, he'll be live in about 40 minutes. Hope everyone's doing good today. Now much better. Get the newsletter, guys. You won't regret it. Smash the like button. Thank you. Yes, and yet let me give everyone the link to the newsletter. This is the link. So there's 3 people who can get it 50% off today. If you use this link, you can get that there. Defaults will jump to 15% sensei. This war is a black swan. Yeah, and if they do, then yeah, then you want to be on the right side of the trade, which is probably a market crash, and be prepared to buy. Is eToro down today? I don't use eToro, so I wouldn't know. Sorry, maybe someone in the chat could let you know. Yes, Sensei, that was about Liz. I always see her in the chat. I haven't seen her this morning. Yeah, I think yeah, she's with her mum today, isn't she? Good morning, everyone, says William Myers. Okay, let's have a quick look at the markets. Big jump on XRP yesterday, which was quite incredible. Let's go over to. It wasn't like a massive jump, but it was quite interesting that we did that video in the morning, and by later on in that day we hit our target. So let me see what's going on in the market. XRP's pretty flat, down 2% this morning at $1.50. Let's see if it holds 150. Ethereum has got back above 2,100. That's coming up to its the Sensei momentum band. I can't wait to share this indicator with you guys. It is so powerful. And I'm not just saying that because I'm always the one that's um, I keep my charts as simple as possible, and they're going to be even simpler now because I don't need as many things because I've just created the perfect indicator. So it's going to be great when the chart training course comes out. You guys can get that as well. Bitcoin is, if it gets back above 74,000, that is very strong. We can be heading on to our next move up. 74,000 is very important. Right now, it's down 1.4% on the day. The S&P 500 is up slightly on the day. I think Nvidia probably pushed it up the most after its event yesterday. Gold up 0.27%, and oil still holding up close to $100. Okay, let me put in the extra channel, and that's where we will go and hang out until Martyn goes live. So if there's any final questions, let me know in the chat, and then I can answer them before we go over to the next show. What's going on? 1 second. There we go. That's been redirected. Let me go over to comments. Good morning, everyone, says William Myers. eToro is down. Yep. Okay, there you go. There you've got your response. eToro is having login issues. So there you go. You've got your response. Let me end the poll. Are we heading into another credit crisis? Yes. This is just starting, says 51% of people. And if it is just starting, well, be prepared for it. Be prepared for all scenarios. Maybe depends on the rates. It does. If rates are, but we're pretty confident that rates are only going to be cut, maybe maximum 2, minimum a rate hike potentially by the end of the year. No, this stays contained, says 14% of people, and not sure, need more information. Hopefully I gave you that information, and go and read the deep dive once again. You can always, something that someone said that they did and really helps is they take the deep dives, they throw it into a good AI model such as Claude or ChatGPT, and then they ask it questions based off the deep research. So the questions that they're not understanding, they can throw in and they say, oh, what does this mean for the crypto market if this occurs? Or what's the chance of this? They can take the report and then they can make, we're looking to integrate something like that in the newsletter, but you can do that for the meantime. Not a bad idea. Anyway, thank you everyone for tuning in. We'll be back tomorrow for the big day, which is a lot of interest rate decisions and Jerome Powell. So that will be big. Make sure you tune in tomorrow. Martyn will be live later, and we'll go to the extra channel now. Go and take advantage of the 50% off this week, only for the first 3 people. Mum says hi and laugh. Thanks, Sensei, again. We sit in the car and she's forced to hear you. Lovely. Thank you, Liz, for tuning again. Hello, Liz's mum. I hope you're well. It's lovely that you're visiting your daughter. Lovely to have you watching Liz's mum. A big shout out to your mum, Liz. Okay, thank you, everyone. Until next time, take care of yourselves and each other. Bye.